Obviously 2016 will be remembered for a number of political shocks. First we had Brexit, and then of course we had Trump's victory in the US presidential election. And really how these play out and unfold over the course of 2017 I think will play a major role in shaping the global economic outlook. If we focus on Trump, really as unpalatable as his opinions and views may be for many, in many ways his victory was a game changer for investor sentiment. On the campaign trail, of course, he promised to increase infrastructure spending in the US. He promised to cut both business and consumer taxes, and that provided quite a lot of positive momentum as we headed into the year end. If Trump can deliver on these expansionary fiscal policies, I think it will provide a timely boost to growth in the world's major economy. The global economic cycle was at risk of losing momentum last year, and if we get increased spending from governments in the US and around the world, this could provide a timely boost to growth. Of course, we need to be very careful of the protectionist policies as a consequence of both Brexit and Trump. It's quite a worrying trend, and it's something that needs to be monitored closely over the coming years. But if we focus on the year ahead for 2017, this expansionary policy should boost growth. According to the IMF, they were expecting a pickup in growth to 3.4% in 2017. It's not an even picture globally. The US will continue to be the major driver of growth. US economy expected to expand over 2%. Europe slightly behind at 1.5% growth. I think the UK will do well to avoid a recession given some of the headwinds from the Brexit negotiations. And although we are concerned about a build-up in debt, particularly in the housing market in China, the IMF continue to forecast growth above 6% for next year. Certainly Europe will enter the political fray in 2017. First up, we will see the triggering of Article 50 by the UK expected in March. Unfortunately, so far, comments from Prime Minister Theresa May and her cabinet suggest that we will see a hard Brexit. It's very difficult to see the UK detangling itself from 30 years of integration into Europe, and certainly leaders on the continent are adamant that for access to the single market, the UK will need to accept free movement of people, which is very difficult to sell to the electorate in the UK after the Brexit result. On the continent, we also have elections in the Netherlands, France and Germany. I think after Brexit, and particularly the no vote in the Italian referendum, these elections could be seen as votes on the future of Europe. Of the two most important nations, France and Germany, I would say encouragingly the pro-European candidates in Merkel and Fillon are in the lead, but of course, as last year highlighted, we need to be very careful not to extrapolate political polls into election outcomes. So this raises the prospect of another difficult year for Europe. I would highlight one difference between the situation today and that which existed in 2011, in that Europe now has a lender of last resort. Mario Draghi and his colleagues at the ECB remain committed to providing stimulus and indeed stability to the Eurozone, and remain committed to do whatever it takes should conditions warrant over the next 12 months. There are a number of important implications for investors. Firstly, if governments deliver on their promises of increased fiscal spending, that should be good for growth. So far, the markets have responded very positively since the US presidential election. I would also say that secondly, we are seeing a transition from monetary stimulus to fiscal stimulus. Central banks around the world are realizing that their zero interest rate policy and quantitative easing has really done all it can to revive growth in their respective economies. There are also signs that inflation is beginning to pick up, oil prices are higher and wages are beginning to rise. In fact, the Federal Reserve felt confident enough about growth and indeed concerned enough about inflation in December to raise rates for only the second time in 10 years, and they're penciling in 2 to 3 rate hikes in 2017. What does that mean for investors? Typically, the combination of faster growth and rising interest rates is typically not good for nominal assets such as bonds. However, this environment tends to be more positive for real assets like equities and property. Although I would caution investors not to overextend themselves in the more risky parts of the market, as some areas of the markets look overstretched on a valuation perspective. our Outlook report, we published a number of key investment ideas for investors in 2017. If I were to focus on 3 key ideas, the first would be US financials. Rising interest rate environment is typically a good environment for financial institutions as their profits tend to rise with higher rates. If we combine this with an improving US economy, more buoyant consumer, and the prospect of less regulation with Donald Trump in the White House, we think that US banks and other financial institutions could do well in this environment. The second idea I would highlight is increased infrastructure spending. According to consultancy group McKinsey, some 57 trillion worth of spending is needed on infrastructure globally over the next 15 years. Already a number of very ambitious projects in China, Europe and the US are underway. And we think that companies which can help build everything from roads to bridges to hospitals are in a good position to benefit. Finally, I would highlight healthcare as an investment idea. There are a number of long-term secular trends happening in the world today, such as aging populations in the developed world and growing epidemics such as obesity, which is increasing demand for many drugs. Also, on a fundamental perspective, the healthcare sector is trading at its lowest level on a price-to-earnings basis than it has done in the last 6 years, and we think this provides an opportunity for investors to build a long-term position.